house prices went up just 0.1% over the last 12 months. So obviously they're just going to go up another 0.1% over the next year. Am I right? Well, that's the logic that a lot of Kiwis are using right now. But I've spent years studying this stuff, and my articles about economic and house price data have been published in the NZ Herald while I host New Zealand's most downloaded property podcast. So in this video, you're going to learn the real science behind the property cycle and how to use real data to make smarter decisions in 2025. But before we talk about whether house prices will rise in 2025, we really need to clear up a few things, because the average Kiwi is looking at the market completely wrong. So here's what we're going to do. Let's break down the 3 most common misconceptions I hear all of the time. And using each one, I'll show you the actual science of how the property market really works. Now, the first misconception is people assume that because property prices move in cycles, each year is like a domino effect. If property prices go up by a lot one year, then that's going to happen again the next year. And if property prices go down a lot one year, well, that's definitely what will happen the year after too. So here's a graph showing how fast house prices have gone up and down. The worst ever return is on the left and the best ever return is on the right. And what you can see from that is that house prices tend to go up more often than they go down. In fact, they've gone up roughly 5 out of 6 times. Now, that's interesting. But here's the twist. Here is the same graph again, but this time with what happened to house prices in the 12 months following. So in March 1993, house prices had gone down 2.2% over the previous 12 months, but in the next 12 months, they jumped 12%, a hell of a lot more. But then in July 2021, house prices were up by more than 30% year on year, but instead of continuing to soar, they fell 3% over the next year. Not spotting a pattern there. I'll give you one more example. After falling by 4.8% in 2008, house prices actually rose strongly by 9.6% in the 12 months after, only to fall again by 2% over the year after that. Now, do you see a clear pattern here? Well, the housing market doesn't work in some sort of neat sequence. There's no real consistent pattern. Bad years aren't necessarily followed by more bad years, and good years where house prices soar aren't automatically followed by more good years where house prices go up even more. So if you see house prices going up by a lot one year, it doesn't mean that's what's going to happen in the next 12 months. And just before we get to the next point, if you're serious about building wealth through property, you can book a free portfolio planning session with my team of financial advisors. And after just 60 minutes, you'll walk away with your own wealth plan that shows you how many properties you could potentially buy and how much you could potentially make. The link for that is down in the description. But the second other big misconception I see is that investors look at a graph showing that property prices have gone down over a few months, and then they panic, and they think that that is what's going to keep happening. They see the line and extend it out. So an investor once said to me, Ed, I had to drop my rent $20 a week because the rental market was a bit tough at the time. And he said, that's just not sustainable. And I said to him, no, that's not sustainable if you keep dropping your rent by $20 a week every single year. But that's also not likely to happen. And the issue that I see is that people look at a graph with a line going up or a line going down, and then they extend it out and they ask, well, what happens if that trend continues going down forever? What if that line is the new trend? And this is what us economists often call extrapolation bias. And this has really come up in the last probably couple of months, where New Zealand house prices are basically flat. But some months they're down 1% and sometimes they're up a little bit. But that doesn't mean that house prices are about to spike or crash, because house prices naturally bounce around during the year because they are seasonal. So you've got to understand that these types of seasonal effects happen in all different parts of the economy. And I'll give you my favorite example. Over in the United States, vasectomies, that's where guys get the snip, spike 30% at the start of March. And I'll tell you why that happens in a second. But if you're a young urologist who makes you money giving guys the snip, you might see that 30% spike in bookings and think, wow, my company is going to the moon, I'm going to be rich. Only to find out that the next week or the next month, that trend turns around and you're back to where you were. You only find out later that the reason procedures spike in March is because of March Madness, a massive basketball tournament. And a whole heap of guys say, well, you know what? If I'm going to have to sit on my couch doing nothing for a few days, I might as well book that procedure for a time where there's something good on TV. And believe it or not, that is the exact same thing that happens in property, except that house prices are weakest over late autumn and over the Christmas break when everybody is away, and then they bounce back in spring and also in February. So as an investor, you need to stay calm and look out for the data that is seasonally adjusted so you don't panic sell or prematurely exit the market. And the third misconception is if you treat all property news as gospel without asking who's writing this and why. So even with this YouTube channel, I'm a property guy. I invest in property. My company helps people invest in property. But even if I try to be as neutral as possible, which I do, my perspective will naturally always fall on the pro-property side. But the opposite is also true. And two of the ways that media organizations get more clicks is talking about two things. Firstly, talking about house prices, and secondly, talking about anything negative. Because us humans have this inbuilt negativity bias in our brains. We pay way more attention to threats and bad news compared to good news. And that is the exact reason why the media is often pretty negative, because you end up clicking on and reading more articles that way. Which is why it didn't really surprise me that the Kaka quoted banks saying that house prices in Auckland and Wellington won't hit their previous peaks until the 2030s. Now that sounds really scary, but what does it actually mean? Well, Wellington City house prices are about 26% below their peak. So to get back to the peak, they need to go up 36%. Now, the 2030s are 4.5 years away. So if you're telling me that house prices could go up 36% in 5 to 10 years, given that the average house price in Wellington City is around $950K, we're talking about them going up $342,000. Now, do you see how easy it is to take a statistic and make it either good or bad based on your perspective? And what this really comes back to is that headlines are designed to grab your attention, not to tell you the whole story. Sometimes, and in fact, oftentimes, they leave out context, and other times they sound negative even when the underlying data is positive. And so when you're reading the news articles, firstly, you've got to read the whole article, but then also ask yourself, well, what's this data saying? What's it being compared to? Maybe that doom headline is actually just describing a pretty normal property market recovery. So will house prices go up in 2025? Well, as you've seen, no one really can predict exactly what will happen over the next 12 months because short-term movements in the property market are very random. They don't follow nice, clean patterns, and they don't care what happened last year. And I think, in fact, if you think about the seasonal trend, seasonally adjusted house prices are roughly flat at the moment. So since house prices tend to go up in spring, it is highly likely that they will go up over the next couple of months. Then they're probably going to fall a bit in January and December, and then they'll rocket back in February. But whether that turns into sustained property price growth, that's where we need to keep our extrapolation bias in check, because trying to predict the market, especially over the next 5, 6, 7 months, that's the wrong goal. The better question is, well, what should you do regardless of what happens to house prices over the next month or whether they go up or down? And instead, you've got to focus on what you can control, the quality of the deal or the property you're looking at. Are you buying in an area with high demand, limited supply? And do the numbers make sense, even if the market stays flat for the next 12 to 18 months? Because long-term property investors, they don't rely on the perfect timing. Instead, they just buy the right property and wait. And if you do that, well, it won't matter whether prices dip 1% this quarter or rise 3% the next, because 5 years from now, 10 years from now, you'll be glad you moved when others stood still. And if you want to take things further, check out Opus Plus. This is the app I created for you guys and this channel, so you can run the numbers on any investment property in New Zealand. The link's down in the description. So now you know why trying to time the market doesn't really work and what drives house prices instead. But the fundamentals won't matter if you're not looking at the right properties. So watch this next video where I break down the best ways to find investment properties in 2025, including the exact tools, tactics, and strategies I use with our clients.